Hello and welcome to another Property Solvers podcast. And today I'm delighted to be joined again by Simon Misiewicz, founder of Optimise Accountants. And we're going to be discussing all things tax when it comes to buying, selling and trading property at auction. So first off, how are you doing, Simon?
I'm doing very well, and I'm looking forward to our chat about auction properties and tax.
Great stuff, great stuff. Well, thanks for getting involved. I know you're always busy, so I always appreciate your time. So perhaps we can start with a broader question. And now that the new Labour government's budget has had the chance to percolate into the property sector for a couple of months, how are you finding things there at Optimise in your work with the property sector in general?
It's been an interesting time. It's new news that landlords are being attacked by the UK government. This is not the first time. We've had this with the Conservatives, where they brought in place the 3% stamp duty land tax high rate. They brought in different rates for capital gains tax. And I think that the Labour Party are just trying to push on with more tax changes for landlords. I think that there is going to be a period of settlement for people just to adjust. It doesn't take away from me that UK property is still a fantastic opportunity. And one thing I am seeing a lot more of is the amateur landlords definitely are selling up. So people that have accidentally acquired property through inheritance or by having a second home and moving into a new home. Those type of investors, landlords, have now exited the market, and it's professionalised industry, if I'm honest. So there are a lot of opportunities still for landlords.
Yeah, interesting. And what do you think were the main features of the budget that have impacted property investors and landlords in general?
I think the big one that people should be focusing on is the 5% stamp duty higher rate. I think that was a blow to many of us trying to buy property, increasing from 3%. It was already high. Where I felt it felt a little bit backwards, because they did talk about increasing the 2% foreign surcharge stamp duty for people that are not UK residents buying UK property. The stamp duty is 2%, an extra 2% on top of all the other surcharges. They were talking about increasing that to 3, 4, 5%, but they chose not to do anything at all. Instead, they, for me, it felt a bit more against UK landlords, because it is they that pay that extra 2% from 3% now to 5%. So I felt that was quite hurtful and almost petulant in some of the approach that they was taking on that stamp duty. In other news, though, I felt that the capital gains tax equalised. It felt very discriminatory against landlords when they pushed up the rate to 18% from 10% as a basic rate taxpayer. And they also moved the high rate tax band on capital gains tax from 20% to initially 28%, but brought it back down to 24%.
Right.
But now it feels as though, well, let's just equalise the whole thing. So landlords and other investors have the same capital gains tax rate of 10%. The basic rate taxpayer is going to be the high rate. And then you got the 24% for the high rate taxpayer. So they're not discriminating against landlords now. So that's it was a little bit more fair, I think.
Yeah, and they reduced the personal allowance, and that's been kept at 3,000. Is that right?
Yes, and again, they did talk about removing that. I think over time, if you look at the amount of relief that you get, let's not think about things like dividends, because you as a landlord using a limited company, you benefited from £5,000 dividends tax-free. That was shortened to 2,000, then shortened again now to £500. So there are some upsides, but there's some certainly downsides to these changes over time.
Yeah, interesting. So what I'm going to do is kind of carry on with what you've just been talking about. Is kind of split this into two sections. The first will be property taxes when buying at auction, and then we can talk a little bit about selling at auction and what kind of tax implications there are there as well. So perhaps we can start with buying. And yeah, with the stamp duty, anything under 40,000, there is no stamp duty owed. I think that's stayed the same, which is probably good for people that are buying and selling in the Northeast, where you can still get properties at that kind of level, high yielding properties. So you know that market, I think, particularly amongst traders, is actually gaining a bit of activity, which is quite interesting. So from what I understand, for every £2,000 you're spending, you're putting an extra £2,000 for every £100,000 you spend on a property. But could you kind of broadly run through how the stamp duty regime works under these revisions that were announced in the budget?
Yes, putting it simply as well, there are, from my view, there are 3 stages of stamp duty now. There is the what I would call the marginal rates. So up to £250,000, you pay no stamp duty, land tax at all. That is, of course, until April, because now there is a further change that seems to be kept quiet, where in the budget they announced that the stamp duty up to £250,000 could be adjusted back down to £125,000, which it was originally. So then you pay the higher stamp duty rate. You pay the new scaled rate beyond £125,000. Right. So you do have that rate. So there is the scaled rate, and then you have the 3% stamp duty land tax. That's now 5%. So what they call the stamp duty high rate. And then for foreigners buying UK property, then they have this extra 2%. So there are 3 layers now of stamp duty that people need to consider. But for UK people, you have the scaled rate, and then you have this new 5% high rate as well.
Right, on top of that, so it's effectively a surcharge. Okay, and I saw a video with yourself and Louise, who's your wife and also your business partner, where you mentioned that foreign investors are actually benefiting more from the new regime. Could you perhaps go into that a little bit more and why you think that is?
The reason for it is because the original talk was to leave the 3% as it was, and then just focus on the increasing the 2% foreign surcharge to maybe 5 or even higher. And they chose not to touch the foreign surcharge at all, and they left that at 2%. But instead, they focused on the 3% and moved that to 5%, which of course attacked UK landlords and investors. Now, admittedly, foreigners do also pay that extra 2%. But in my view, I thought that the challenge that the UK government had was to stop foreign investors buying UK property. And that would have been a good move. Now, interestingly, in the news in recent times, and I'm in Spain, and it's something it looks like it's not going to go through. But the Prime Minister over here in Spain talked about increasing 100% tax on people that are non-EU residents. And that really would push against any foreigners trying to buy property, including British. And I felt that was an interesting dynamic because they are a very socialist government, and they really are making the right noises. Not that it will go through, but there was definitely an emphasis of focusing on the people that are in the country and trying to dissuade foreigners from buying UK property, which pushes up prices. And I felt as though the Labour Party should have done something similar. Not the 100%, of course, that would be just too crazy. But I felt as though they attacked UK landlords, investors as well, and they should have focused on foreigners.
Yeah, interesting. Okay, and what are the main exemptions from stamp duty that buyers should be aware of? I've got a few ideas that I wanted to kind of put past you. Perhaps the first one is buying multiple properties. How does that work specifically in terms of saving on stamp duty?
Yeah, so that's an interesting one. So there used to be something called multiple dwellings relief, or MDR, And actually, that has now gone. You can't use multiple dwellings relief to reduce stamp duty land tax when buying multiple properties. Now, the only time you could utilize that type of relief of buying multiple properties is when you buy 6 or more. So let's imagine that you decide to buy a block of flats, and inside that block was 6 units. That would actually be considered to be non-residential property purchase. So you wouldn't pay, for instance, the 5% stamp duty land tax. You would pay a commercial rate instead. So you would save quite a significant amount. So that's one relief. So the MDR no longer exists where you buy 5 or less properties in one transaction. But if you buy 6, it will be considered to be a non-residential purchase, so commercial to you and I, and that helps you to lower your stamp duty and removes the 5% stamp duty to land tax rate. And also the scaled rate is slightly less as well.
So just a quick thing then. If say you're a landlord and you buy like 6 different properties in different locations at an auction, would that still be the case? Would you still be able to benefit from that relief?
Yes, you would. If you buy 6 or more, yes, you would.
Oh, that's interesting. Okay, so they don't have to be like the same block or the same street or anything like that. It's all
as long as
the actual
it has to be. So what it is looking for is from the same seller, though. So if someone's selling a portfolio, for instance, and you buy that portfolio off the seller, and it's 6 or more, then you would get that reduction.
Okay, but if it's separate sellers, then you wouldn't be. No. Okay, interesting. Sorry, I interrupted you there, Simon. You were going to mention something else?
Yes. The only other one was the commercial and residential mixed use. So let me give you an example here, which I think there is an untapped market where you have a high street and you have a shop or a restaurant, and above it you have a flat. Well, that is called mixed use. So it's got a commercial element as well as a residential element, and that makes it a mixed use property. And the mixed use property really benefits from, again, non-residential rates of stamp duty land tax. So you don't have to pay the 5% stamp duty high rate. It is at a lower scaled rate. And the reason why I say it's untapped, because I just don't see enough investors looking at those kind of things. Now, I've been to a few auctions. I've purchased property through auctions. And I've always see these type of properties up in the auction, whereby it's, like I say, a restaurant or a shop and then a flat above. And there's never been many people buying it. And one of the reasons for it is because it's commercial and it puts a lot of people off. But actually, it does help you diversify risk. It does help you to minimize tax. So it's certainly something that I would love to see landlords explore more in the future.
Yeah, I mean, there is almost an oversupply of those kind of properties. So there's some good deals to be done for sure. I think people tend to look at them as a bit more risky because, they approach a mortgage company and the mortgage company will say, we're going to take a different view of the flat above because it's above a commercial and things like that. So, your options for getting finances are a little bit more constrained relative to kind of your standard kind of 2 up, 2 down or semi-detached property in the Midlands, for example. So there are risks, but if you're buying at the right kind of price, it's definitely an interesting strategy to explore. And I think there is an abundance of opportunities of those type of properties. The other one that we've tapped into here at Property Solvers is uninhabitable properties. So effectively claiming the stamp duty you pay back for a property that's uninhabitable. So you effectively have to prove to the HMRC that the property is uninhabitable, and they want some kind of clear evidence of that. Have you been kind of exploring that with your clients at all?
A lot of clients do work with this, and we do see a lot of clients that get rebates. And I say rebates because when we talk to our clients when they're buying property, they'll say, "Oh, I bought a property that we had to rip out all of its innards, so the bathroom, kitchens, and so on. And merely replacing bathrooms, kitchens doesn't make a property uninhabitable. But what's really interesting is when you hear things like, oh, the house was boarded up. When I got in there, there was no running water, all the things was ripped out. There wasn't much left in the property. And at that point in time, you have to listen very carefully. And this is where I always say to property investors, have you spoke to your accountant before you buy property? Because there's always going to be something that your accountant can advise you on. So in that scenario, we always listen to our clients and say, well, okay, explain more. Why was it boarded up? What happened to the property? And you hear stories of, well, the roof, there was holes in the roof. No one could have lived in this property. But then you find out that the solicitor still charged the normal residential rates, which it's not residential rates, it becomes non-residential rates. And not only do you potentially lower the scaled rates of stamp duty land tax, but you also probably have overpaid as was the 3% stamp duty high rate, but now is the 5%. So it's quite a costly mistake to make. So yes, there's a great opportunity for buying uninhabitable properties. And just to add to that, what I love about uninhabitable properties is that if you bring a property into use that it's been empty for more than 2 years, which again, if you think about probate properties that you see in auctions, and you know it's been empty for 2 years because it just looks run down. The nice thing about that is you can have the VAT that builders charge you for bringing that property back into use reduced from 20% to 5%. So you can actually save 15% on VAT.
Oh, that's interesting. Oh, wasn't aware of that one. And the other one was chain breaks. We haven't looked into it. It's something that I've heard about. Perhaps you can talk a little bit more about that. Is that a similar kind of rebate process as what exists with uninhabitable properties, or how does that work specifically?
So this one is quite complex. This is where the stamp duty rates are significantly reduced, and the chain breaks, I'm imagining you're talking about a deal falls through from a estate agent.
Okay. Yeah, and then say, for example, a buyer such as one through ourselves, Property Solvers, we come in and we make an offer which is acceptable to the seller. Would we be able to kind of then claim back our stamp duty on that basis?
It would be at a lower rate for sure. So there would be some sort of rebate. And not only that, there is another situation whereby you may find that, and it's linked to probate properties, because again, there are stamp duty exemptions and reliefs whenever you buy property through a fallen through transaction that you talked about, or if you buy a property through probate. Now, in both of those cases, it is a case-by-case scenario. So it's not something that someone listening to this should think, oh, okay, I can just go off and talk to my agent and just put this into process. The reason why I say that is because there is a very detailed legislation around how much you can spend on the property, which is there's a fixed rate and a percentage rate as well. So that can cause confusion. But you also need to sell the property. So you couldn't keep it for yourself. So that's now one of the ways that we've circumnavigated that particular law is where you buy it in one limited company and then you move it into another company within a group, because group transfers, there's no stamp duty, land tax or capital gains tax. So there are ways around this, but again, I would say it's very much on a case-by-case basis because it's super complex.
Sure. I guess that's important. Highlights the importance of working with a good accountant, really, who can kind of explore these areas, speak to the HMRC, and understand what actually can and can't be done.
It is, but let me just restate. I think it's what I do find is that I don't see enough landlords talk to their accountants. I think they have bought or sold properties, and then they say to their accountant, "Oh, I've done this," and it's too late because the transaction's been done. So it's really about landlords, investors listening to this. please do speak to your accountant more. I know that sometimes numbers are complex, but do yourself a favor, have a conversation, see where the tax mitigation plans may come in to help you.
Sure. And on that question, is it possible to ever do things retrospectively? Like, say, for example, you feel like you could have saved money on something like stamp duty. Is it possible to go back to the HMRC and seek out some kind of rebate on the basis of a calculation that you didn't do beforehand?
Yes, and there are times when you can do that. So one of the things that you could do is if you replaced your home, for instance. So let's imagine you had a home, you wanted to keep it rented out because you have personal sentiment towards that property, but then you buy another home. And you will actually sell that property, the first property. Well, in that transaction, if you buy a home and you don't replace your current home, then you would have to pay the 5% high rate. But if you choose to change your mind or you move your first home into a limited company, which again, we do help our clients do, then you can claim back that new 5% stamp duty high rate.
Right.
Conversely, if you buy a property and your solicitor made a mistake by charging you the incorrect stamp duty because you have purchased an uninhabitable property, then you can go back and make claims and get your money back from HMRC.
Well, that's great. That's great. Okay, so I wanted to touch on the stamp duty regime for commercial acquisitions and land, because I think more investors and auction buyers are moving into this space, given kind of the punitive nature of residential stamp duty. So could you give us a little bit of a summary of how that effectively works for commercial acquisitions?
Yes, and I think there are two things I'd like to discuss. The first one is a new trend, and I say new, it's probably been going on for 5 years now, where people would buy residential properties. They get a scaled rate plus the 5% rate, which is obviously the new high rate. And one of the strategies that we've seen for quite some time, ever since this 3% stamp duty actually came in, we started to advise our clients to buy a commercial property and then convert it into residential use. Why is that useful? Well, you instantly make a saving on buying a commercial property than residential, especially in certain areas, because commercial properties may not be as highly valued as residential property. So sometimes you can get a good deal by buying commercial, especially if it's being left empty for a period of time.
It's competition, as well.
Yes, so things like that, right? So there's that. And then you have this notion of, well, stamp duty and land tax is reduced. So you've made a saving on buying the property in the first instance, but now you're buying a property with stamp duty. You don't have the 5%, you have less of a scaled rate as well. So you're saving stamp duty land tax. In addition to that, again, if you convert a if you convert a commercial property into residential use and you are being charged 20% by your trades refurbishment agency, then you could have that VAT reduced from 20% down to 5%, which will save you 15%. And there are times where you can actually reduce the whole thing to 0% if you later on sell the property. So there is incredible amounts of deals out there. Yet again, I don't feel it's been taken up. And I understand it because it's quite complex and new. But there's so much opportunity that buying residential property, for me, should be, well, a second option. You should be looking at better deals, whether that's bare land, which again, bare land is non-residential use for stamp duty, or looking at commercial properties and saying, well, actually, let's take it on as a commercial property and keep it as that way. Back to your opticians, could there be an opticians that you have a long 25-year lease deal? Let's be fair, an AST is 6 months, but you can get commercial arrangements where it's 20, 25 years. Or do you latterly convert it from commercial to residential because there's permitted development rights in that local area?
Right. Interesting. A lot of opportunity out there, and I guess it's just a case of tapping into it and seeing how you can get your foot in the door and take advantage of these opportunities, because the residential space is very competitive, and if you could look into these other areas, then I think that's definitely a good way forward. And what other things can be done to minimise taxes in general when acquiring properties at auction or for investment purposes?
So again, speak to your accountant. I know I feel like a broken record, but the amount of times I see people saying that they've changed accountants to move to us. And the thing that they often say to us is, well, our accountant never really reached out to us, and they didn't understand me, and they didn't give me some proactive advice. And my next question often is, well, how often did you contact your accountant? And they say, well, I didn't. I say, well, that's not going to happen then, because they cannot read your mind. They do not know when you're going to be buying property. It's a two-way conversation that you will need to spark up. So I think, just always going back to your accountant, and just to reiterate that point. The point of buying property, the one that I used to do, and I bought 14, 15 houses this way. I would always buy properties that are in need of loving care, tender loving care, TLC properties. Yeah. Why did I do that? I used to buy properties that an old couple were downsizing from. Maybe they're going from a home, or maybe they're going to downsizing to, instead of a 4-bedroom house, into a 2-bedroom house. But it hadn't been updated for 20 years, and you could always tell. What I like about that is that I could take that property, and at that time, I could rent that property out for, let's say, £500-600 per month. But actually, if I replaced the carpets, repainted the house, replaced the kitchens and the bathrooms, then I would, of course, get more rent, which is always favourable for the long term. In addition to that, I was also able to utilise the refurbishment costs against my rental income, which is often where generic accountants don't understand that ruling, because even in HMRC's literature, they have this replace, repair, renew narrative in their own legislation, which allows them to say, well, if you're going to be replacing bathrooms, kitchens, if you're repairing a roof tile or broken furniture, or you're going to renew your paintwork, then that is all offset against your income, provided that the property is in a lettable condition. Well, I was always saved by this, because I would buy a property, like say a TLC property, I would get a mortgage. And what does that prove? Well, it proves that the property is in a lettable state, which for HMRC legislation references gets me out of jail. So when I offset, at that time, it was between 15 and 20,000 pounds for a refurbishment. I would take all of that and then offset that against my income. And that strategy helps me build this property portfolio with Louise. Like I say, 14, 15 properties. I can't remember how many we ended up going. We went beyond that, but using that one strategy, we did about 14, 15. And we didn't pay tax in 8 years.
Well, would you refinance those properties once you've done the work to them? Would that be the overall objective?
Yeah, I've heard some people do that. This is the BRRR strategy, the buy, refurb, refinance, rent strategy. I never did that, and the reason for that is because I didn't need the rental income. I was fortuitous that I had, even when I first started this, and I wasn't a tax specialist at the time. I was a consultant, and I didn't need the income, so I didn't need to really pull money back out of the property. But it's a very good strategy for people at that time to take the money out of financing and then put that money into a new property deposit. But because of Section 24, and I don't want to get into too much detail for this particular podcast, but Section 24 really scuppered that as a strategy if you're buying property in your own name. And this is why I always say to people, if you're buying property, just buy it in a limited company. You are shielded from so many tax issues. But Section 24 really scuppered that to say, well, If you buy property, you did some work on it, then you pull more money back out of it, as in increasing your mortgage. The mortgage interest would be a cost, which means you make less money, but you don't get the tax reliefs. So you could end up being out of pocket every single month simply following that strategy. So it doesn't work in your personal name, but it certainly does still work doing that BRRR strategy in a limited company.
For sure. We did actually touch quite a lot on Section 24 on our previous podcast. So if listeners want to check that out, we went into depth into this whole topic. And another thing about trying to minimize the amount you refinance is that you don't want to be gearing yourself up too much as well. Sometimes if you bought a property at a good price at auction, and then you just refurbish it, you've got a good chunk of equity there, which will help you kind of withstand any potential turbulence that could happen in the market. So sometimes gearing reasonably low is a sensible idea, and making sure you've got that chunk of equity in your property, so you can get through the storms that inevitably come. So on that kind of topic, with regards to the actual costs, transactional costs involved when buying a property at auction, everything from legal fees, bridging costs, any other kind of costs that are involved when you're actually out there buying properties. What can be offset from the start? In your first tax return you do after buying a property, what are the main costs that you can offset?
It's an interesting one. So if you're buying a property from auction or anywhere for that matter, the kind of costs that you'll incur typically would be stamp duty, land tax, and legal costs. And inside that legal cost may be finance arrangement costs as well, but they'll chuck that into legal. And those are on initial purchase, they will be capital in nature. So they will help you to reduce capital gains tax, but it wouldn't help you reduce income tax, for instance. So the initial purchase of a property typically will be capital costs. So your solicitor's fees, stamp duty, land tax, mortgage arrangement fees would be added to the building cost. And when you eventually do sell it, then it would help you to reduce capital gains tax. Now, conversely though, if you have that property in auction, and this is typical of auction properties, that you might go for a bridge loan finance. And this would be, again, mostly your capital, because you're increasing the value of that building. But then when you come to refinance it with a traditional buy-to-let mortgage product, then the refinance, as in the arrangement fees and so on, and the legal fees of that transaction will be offsettable against your property income. So you can move that to reduce your taxable income. So that's quite favorable, but right. It's often misunderstood which way it goes. Can you have that, the initial costs of purchasing a property against my taxable income? No, not the initial purchase, but again, don't forget that I talked about the replacement, the repairs and renewals of a property. They are still offsettable against your rental income. So they certainly do help you reduce your tax bill.
Yeah, and if you're buying properties through a company at auction, are the same costs offsettable against corporation tax? So for example, you sell down the line, you sell the assets within the company.
Yeah, I think the treatment typically, apart from Section 24, the treatment of income tax and capital gains tax are largely the same, whether it's in your personal name or a limited company. Again, just to restate, Section 24 only affects people that buy property in their own name, not a limited company. But everything else typically would be very similar.
Right. Interesting. Okay. So yeah, moving briefly on to selling a property. We often work with a lot of landlords, as you mentioned, Simon, you do, who are selling up because the liabilities they're facing as a result of Section 24 have just increased quite dramatically, particularly over the last couple of years with interest rates rising. So when it comes to capital gains tax, which is probably the principal tax that you're going to have to incur when you're selling a property, what can be done to kind of minimize your overall liability with capital gains tax? There's a couple of things that we've been working on with with yourselves, like looking back at what your initial mortgage costs were, mortgage arrangement fees were, and your original legal fees. But are there any other things that need to be kind of considered when trying to minimise what you pay as capital gains tax?
There's a lot of mistakes that I do see being made, and that's not to reference any conversation that you and I have had, but this is just kind of a general observation I have whenever we have ad hoc tax calls talking about capital gains tax. One of the most fundamental mistakes that people make is that they sell the property and then they later on come to us and say, well, how much tax do I need to pay? And one thing I would say straight away is that we always find this in a relationship. You have one person who is a basic rate taxpayer and another one who is a high rate taxpayer.
Yeah.
And because of that, the high rate taxpayer would pay 24% in the new world, and the basic rate taxpayer would pay 18%. And yet, it is the high rate taxpayer that has property solely in their name. And now there's a missed opportunity of the capital gains tax annual exemption of £3,000 missed. There is the missed opportunity of transferring a proportion of the property over to the basic rate taxpayer to reduce tax from 24% to 18%. So number one is people just do not contact their accountant. And I just want to reiterate, you should. The second mistake that I see people make is talking about the sales price versus purchase price. So, for example, I sold a property for 300,000. I bought it for 100,000. Therefore, I have a taxable gain of 200,000. Well, that's not true, because the sales price of 300,000, you would have had legal fees for that. You would have had an estate agent that you would have paid fees to. And people would say, well, isn't it the 300,000? No, it's 300,000 less than any expenditure you've incurred in selling this property. And we see that often, which sounds really crazy, but it is an often missed opportunity to look at your completion statements and say, well, how much did I actually sell and get for this property? That is what I need to really work out. And then I need to get the other completion statements on purchase, because again, when we say, oh, I sold the property for 300,000, I bought it for 100,000. Well, the 100,000 is not true either, because you may not have incurred stamp duty on that fee. You may have done the 3% rate at the time, but you would have incurred for sure the fees, as you mentioned, the mortgage arrangement fees, the legal fees, and any other search fees that you've incurred. And people just do not check their completion statement. So I think HMRC are often being overpaid capital gains tax than underpaid.
Yeah. So it's always worth remembering to keep all your invoices, keep hold of them, keep them somewhere safe, preferably not in the cloud, because you never know what could happen. Just keep all your invoices and make sure you log everything that you're spending when you're acquiring these properties and selling them eventually. As Simon says, there's a lot of potential costs that can be offset. And would that be the same with corporation tax? So, say for example, you're selling an asset within a company at auction. Is it a similar? Are the same costs tax deductible?
Exactly. There's no change. I would say that looking at an income tax position as well as a corporation tax from selling property is exactly the same. The key difference, though, of course, is that you don't get the capital gains tax annual exemption of the 3,000 each person. So if you're a couple, you could save £6,000 straight away. In a limited company, and the tax rates are different, of course, as well. So as a basic rate taxpayer, you pay 18% in your name, where you pay 19% in the company.
Right. Okay.
The high rate taxpayers pay 24%, which again, the corporation tax now is 25%. So you pay slightly more in a company, but overall, I still think, and I'm not trying to say, oh, he's backtracking now on using a limited company. I'm not. I'm just saying that they are slight nuances, but not fundamental.
Yeah. And you've also got dividends tax and income tax to pay on any money that you withdraw from the company as well, right?
That is correct. Yeah.
Okay. Is there any other kinds of tax implications involved with selling a property at auction that listeners should be aware of?
Not necessarily. I think one of the things that, and it's probably echoing what I do see, but one thing that you might want to look at is when you're going to auction, do have a look at the brochure in detail, because you may say, well, I'd like this house that's being sold for 200,000. And I also like this other house for 250,000. And you might think, well, yeah, the 200,000 one's cheaper. Let's buy that one. And the key difference, I would say, is that the £200,000 property is being purchased from an individual. The £250,000 may be sold through a company. Now, here's the kicker. You could actually spend more money buying the £200,000 property because of the stamp duty land tax. You've got the 5%, and you've also got the scaled rate. But if you buy from a limited company, you don't pay the stamp duty scaled rate, and you don't pay the 5%. You pay 0.5% stamp duty on the shares. So you can save a significant amount. So it's really important to look at the literature in these auction magazines, which I used to always look for those kind of deals, landlords that sell in portfolios in a limited company. And you say to them, well, could I buy the company? I'm quite happy not to buy the properties individually. Can I buy a whole lot?
Yeah.
It's a huge amount of stamp duty land tax savings.
Yeah. Are there any kind of risks involved with that? Say, for example, unpaid liabilities, because effectively, if you take on that company, you're fully liable for whatever debts that company owes. So I guess you've got to make sure that you do your due diligence on the company as a whole before kind of proceeding, right?
Yeah, you should, absolutely. And more so than buying a property just out of someone's name, for sure. But I think that you could do due diligence on a company relatively straightforward. You can buy an Equifax or an Experian credit report. You can look at the balance sheet of the report, again, working with your accountant. But maybe for £500 to £1,000, you pay for someone to do quick due diligence, and they vet it and it looks good, then you can move on. So you might want to put a clause in the auction to say, well, actually, this is based on this company not having too many skeletons. But even if it does, let's be fair about it. You could actually say to the person who's selling the property, I don't actually want to buy the company anymore, but I'll buy the property from the company.
Yeah, you can kind of navigate your way through it. That's great. Interesting. Thanks so much, Simon. It's always really good chatting to you. Always, a wealth of information, so many insights. So how can people find out more about what you do, Optimise Accountants, and reach out to you guys?
Just as you said, actually, just put the three www in front of Optimise Accountants and then put .co.uk at the end of it. Also, do find us on YouTube. We have a great YouTube channel. It's been going now for 10 years. We have over 650 videos to help you landlords and property investors to save tax when you're buying, refurbing or selling properties. So head over there as well.
All into the show notes. And thanks again, Simon. Really appreciate your time and look forward to catching up with you soon.
Absolutely. Thank you again for inviting me.
Thanks, Simon. Bye.